but just polishing off the conversation around metals. First, steel, Pinakin, back in 21, 22, this conversation around the US infrastructure plan was so high that kind of went off. But you never know, it could come back because that country, I presume, is in need for serious infrastructure spend. Our budget has shown that we are very keen in India to do some serious infrastructure spend, and possibly will happen over the course of the next 12 months in the run-up to the elections as well. And prices are probably a factor of what happens in China. But I would love to understand from you, Pinakin, for Indian steel makers, how is the scenario looking both in terms of demand supply as well as in terms of the price impact that might be case?
So if you look at the year which went by, March 23, the fiscal year F23, India's steel demand at a system level increased by 13% year on year. And this comes on a relatively high base of last year. Last year also steel demand had grown by high single digits. So the point is that finally, after years and years of waiting for demand, higher government capex, infrastructure spending is translating into higher demand on the ground. So when a steel consumption base of 120 million tons grows by 13%, that's a lot of steel demand. You have a consolidated industry. You have only 2 or 3 players adding capacity. So to that extent, what you have for the Indian steel makers is, I won't say Goldilocks, but a very positive India demand environment, which for the next few years should remain strong because of the focus on infra, and an export environment which should also remain robust. I don't think India will go back to exporting 15 million tons of steel. But on the margin, if you export more than what you're importing and domestic demand is strong, you essentially will be working out at flat utilizations, full scale, fully utilized capacities. Prices are a function of what happens around China. The way to look at it is that if you are in this $500 to $650 range, with coking coal being lower, then you still make very healthy margins. You make very healthy cash flows. So the outlook for Indian steel is actually very positive versus what the pessimism is out there in the stock prices.
So I take it that you are largely constructive on the companies within your coverage on the steel side.
We would be constructive on the steel names in India.
If indeed companies are able to manage or maintain prices, if you will, I don't remember in the past history cement companies giving up too much of pricing in a hurry, Pinakin. So if that continues to be the case, is there a case for, because of the infra spend, because of the fact that prices are okay and the raw material costs must be lower, could there be a case that despite the impending capacity additions, the market may be a lot more kind to the fortunes of the cement stocks in India?
So market has been a lot more kind. If you look at cement stocks in India, they are trading at +1 standard deviation of their historical average multiples. They are trading at the higher end of the trading range. If you were to run a screen of global cement names, Indian cement names are trading at 2 to 3 times the valuation multiples of their peers. So from here, to take a call that you will see a breakout in multiples is being very brave, essentially, because the multiples are already at relatively higher levels versus where you would normally want the cycle to start at. And the companies at the end of the day have not delivered, the sector has not delivered, very high ROCs. Even today's margins, it's not like the sector is making 20% plus ROCs. So the multiple re-rating is difficult to argue. But again, if you look at the ownership breakdown of cement, unlike metals, is mostly owned by the domestic investors. And if domestic flows remain strong, that will continue to provide support to stock prices.
So any reason why global firms or global clients, some of your clients, are not as largely invested in cement in India?
So at the end of the day, the global investors do tend to take a more relative valuation call. Intra-sector within regions, and B, within sectors in the country. For them, the valuation is something which is a bit difficult, argument to buy into at this point of time.
Pinakin, I've asked you a bunch of my questions. Maybe I missed out on something. Is there something that has intrigued you, interested you across your coverage universe in the last 1 or 2 months, which might be a factor to watch out for the future as well? Any of the themes that we spoke about, or something that we haven't spoken about?
So I think one of the things that we need to focus on going forward would be that if you have a recession, which is not like 2008, which is not like 2016, where there was a sudden collapse in demand, but a gradual wind down of demand, then how do commodity prices react? Because the markets are attuned to 2008, that suddenly demand falls 30%, commodity prices fall 30%, and then within 6 months, you are up and running. If you have the 70s era or the early 80s, where demand is plus minus 1%, there's no new supply, then are we stuck in a commodity price environment which is higher for longer? And then what happens to stock prices? What happens to company earnings?